first quarter certainly had some massive reserve releases. We expect more reserve releases, albeit more modest this quarter. Obviously, first quarter also had some gangbusters trading results. We don't expect that to be repeated in the second quarter, but still, I think the operating environment's been rather constructive. We do expect trading results to be down, as I mentioned. JP Morgan at a recent investor conference got its investment banking having one of its best quarters ever. They think investment banking fees might be up 10 to 15%. So all in all, I think capital markets results should be not quite as good as the first quarter or the second quarter from last year. These were record-setting quarters, but I think they're going to be significantly better than what took place in 2019. So, we'll see what happens. I think you had the chart earlier, but with the U.S. banks versus the European banks, I think the U.S. banks at a minimum should generate double-digit returns on equity, which stacks up pretty favorably against their non-U.S. peers.
Yeah, no, and definitely that's been a consistent theme, not just this year, but over the last couple of years. I just want to go back to these set of earnings, though, because it feels as though expectations have been creeping higher and higher. Just the latest expectations are showing that people are expecting earnings to double in this coming quarter after doubling in Q1 as well. Do you think that the bar is extremely high now for a positive surprise out of these U.S. banks?
It's difficult to tell. It depends which banks you're looking at. In the second quarter of last year, there were some massive reserve builds. So, we'll see how it plays out. From our perspective, being a bond rating agency, banks are in such strong fundamental shape. They're flush with liquidity. They just passed the latest round of stress tests. Capital levels are very strong. So from a fundamental perspective, we see the U.S. banks as being very well positioned. Certainly on the revenue side, with lower interest rates, top line results, could be pressured. But on the other hand, fee income results, whether it's trading, investment banking, or mortgage banking, has been able to, largely mitigate that pressure from the low interest rate environment. Loan growth, obviously we think it's going to be muted again. We think loan growth might pick up in the second half of the year. And again, that's, the lower loan growth has been driven by, still uncertainty. The consumer's been cautious. So, we'll see how it all plays out.